Hi, I'm Christine Benz from Morningstar.com. A sustainable withdrawal rate is one of the linchpins of a successful retirement strategy. Joining me to discuss various withdrawal rate strategies as well as their pros and cons is David Blanchett. He is Head of Retirement Research for Morningstar Investment Management. David, thank you so much for being here.
Thanks for having me.
Retirement withdrawal rates are a really hot topic among our Morningstar.com users. I'd like to cycle through some of the strategies that people use to get cash out of their portfolios in retirement, talk about their pros and cons, and you say there's really no one-size-fits-all answer. It really depends on the variables that appeal to you and that make sense for you. So let's start with the most intuitive way to think about extracting money from your portfolio, and that's to focus on income-producing securities and just spending whatever those kick off. Let's talk about the positives and the potential drawbacks associated with that kind of strategy.
I think that a lot of retirees view income that way. Those that have saved enough for retirement, they have a portfolio. The goal is to live off of the income. I think that that's definitely a very valid strategy. You know, one potential con there is that if your portfolio isn't growing, you're going to have less and less income throughout retirement based upon inflation. So that's kind of a concern if you are thinking about maintaining a constant standard of living. You might not do that through that kind of portfolio unless it's growing over time.
Okay, and let's talk about the current yield environment, how that has made income-focused strategies somewhat challenging for retirees unless they've been willing to kind of edge out on the risk spectrum a little bit.
Well, one issue we see today is that, you know, historically the average yield from large cap stocks has been about 5%. Okay, the problem today though is about half of that yield is going to repurchases, and so more companies are rebuying shares versus giving dividend yields. And so today is a very trying time for investors focused on income because, as we all know, bond yields are low and so are the average dividends from stocks. And so it really is, I think, tough today to create a higher income than, say, maybe 4 or even 5% from a portfolio focused on more income-paying securities.
Okay. The next strategy, this is one that I know a lot of our Morningstar.com users are familiar with. This is the 4% rule, and that really involves a static dollar withdrawal amount that then gets inflation adjustment in subsequent years. Let's talk about that one.
Sure. So that came about over 20 years ago, research by Bill Bengen, and there's been a lot of research since then. I think that, you know, one issue with the 4% rule, as it's called, is it's often misunderstood. As you said, the 4% rule applies to the initial withdrawal rate, where that amount is increased by inflation. So I actually call it a 25 times rule. You need 25 times your initial income goal. 1 divided by 4% is 25, and that's kind of the starting point for retirement. I think that that's an excellent place to start for most retirees. I've done some newer research with Wade Fowler and Michael Finka talking about, you know, maybe lower withdrawal rates are a better starting point today. I think that a key issue for a lot of retirees, though, is how does your income profile change over your lifetime, and what is your required level of certainty? You know, do you really have to have the same amount of income in today's dollars every year for 30 years? And if not, other strategies might work better.
And you have done research about how retirees' spending needs tend to fluctuate over their life cycles. Let's talk about that.
I think that, you know, one assumption that almost everyone makes when it comes to retirement is that your income need increases every year by inflation in retirement. So if you spent $10,000 last year, inflation's 3%, you're going to spend $10,300 the following year. And if you actually look at the actual spending of retirees, that isn't actually the case, where people actually tend to reduce their consumption in today's dollars as they move through retirement.
Okay. So you said, and you referenced a paper that you had worked on with some co-authors where you kind of poked at the 4%, that initial 4% withdrawal rate, suggested that potentially that's too high for some retirees. Is that the case for everyone, or should some retirees feel okay about taking that 4% initial withdrawal?
So I think that, you know, if you are a retiree who has to have a guaranteed amount of income that increases every year by inflation for 30 years, then 3% is the new 4%. You have to have effectively about 33 times your income goal when you first retire. However, for most people, they have Social Security, they have defined benefit plan benefits, they have other sources of income. And so if their portfolio were to fail, so to speak, it wouldn't be disastrous. So I think that, you know, 4% is a great starting point for a lot of people. 5%, even 6% can work based upon your overall kind of level of risk tolerance.
And it also depends on your age, correct?
Of course.
That as you get older, you could arguably take more from
yes,
the portfolio.
and if you're single versus married, all these factors look at, how long is retirement going to last? If you're 65 years old and married, joint couple, maybe 30 years. If you're retiring at 60, it could be 35 years. So all these things play into what is that right withdrawal rate based upon the remaining duration of retirement.
Okay. So the next strategy that we want to discuss is what you call the endowment approach. This is where you take a fixed percentage of your portfolio and you take that year in, year out, regardless of what your balance is. So let's talk about the positives and the potential drawbacks associated with that strategy. One obvious drawback is that you have that fluctuating income stream, which may not be agreeable.
So I think that, I call it the endowment approach because endowments, like a college endowment, takes out a fixed percentage every year. And I think that it can make a lot of sense. One benefit with the endowment approach is, if 4%, let's say, is the right number for a constant withdrawal amount, 6% is actually the right number for the endowment approach. And one benefit of that is that you kind of know your ongoing withdrawal rate from the portfolio. A pitfall is that it possibly will decrease over time. If you take out 6% per year, without healthy market growth, it's not going to maintain that 6% level of income every year. I think that you can do things that kind of smooth that out over time. One example is, for example, endowments. We take the average of the last 3 years' value. So look at what was your account value, what is it now versus a year ago, and then 2 years ago, and average those three values to figure out what the actual withdrawal should be.
The last strategy I want to discuss is the endowment approach, but with a twist. So you say, I'll focus on this percentage per year, but I won't take any more in dollars than X amount, and I won't take any less than Y amount. Let's talk about the pros and cons of that strategy.
I think the key really is for a lot of people is to figure out, what do you need, right? Not just today, but also throughout retirement. And obviously things change. The markets haven't behaved very well over the last decade. And so I think that if you don't go back and revisit what is your withdrawal amount or rate, things can get out of whack. And so going back and saying, hey, this year I can take out, say, 5%, but I need 6%. Okay, well, you can do that, but that means at some point in the future you may have to take off less. So I think the key is really kind of figuring out what those boundaries are over time and then readjusting your withdrawal amount based upon portfolio performance.
So flexibility, it sounds like, is key.
Well, and if you don't have flexibility, it just means you have to take out less, right? That's where I think that 4% is a good starting point. But if you absolutely need the income, you have to be more conservative, say 2.5% or even 3%.
Okay, David, such an important topic. Thank you so much for being here to share your insights.
Thanks for having me.
Thanks for watching. I'm Christine Benz from Morningstar.com.